Welcome to Explain the Charts, where today we are conducting a deep dive into the PUSD currency pair on this March 16, 2026. The current market environment for the British pound has turned significantly bearish over the last few trading sessions. Recent news indicates that the UK GDP unexpectedly stalled in January, which has fundamentally weakened the sterling's position. Simultaneously, the US dollar has been on a tear, bolstered by better-than-expected JOLTS job openings report data. Global tensions in the Middle East are further pushing investors toward the safe-haven US dollar, creating a perfect storm for this pair. Technically, the cable has broken through several key support levels that had held firm throughout the previous month. Looking at the broad daily chart, we can see a clear trend of lower highs and lower lows developing since late January. This indicates a definitive shift from the bullish sentiment we saw in the early part of the year when prices were near 1.38. The recent slide from the 1.35 level down to the low 1.32 range represents a significant momentum shift. In this video, we will analyze these trends and identify where the next reversal or bounce might occur. We'll also look at the intraday data to see how the market is reacting to the immediate fallout from the GDP news. Let's narrow our focus to the price action since the start of 2026 to see the breakdown more clearly. On January 5th, the pair opened at 1.3437 and rallied strongly, reaching a peak close of 1.3825 by January 27th. However, that 1.38 level proved to be a massive resistance zone, leading to a sharp 0.92% drop on January 30th. Throughout February, the pair attempted to stabilize, but every rally was met with heavy selling pressure near 1.37. The failure to reclaim the 1.37 handle in mid-February was the first major warning sign of an impending reversal. By March 2nd, the pair was struggling at 1.3409, and we began to see the volatility increase as fundamental data started to leak. The daily candle on March 13th is particularly concerning, as it shows a massive drop from an open of 1.3351 to a close of 1.3222. This nearly 1% decline in a single day was triggered by that UK GDP shock we mentioned earlier. The low on March 13th hit 1.32135, which currently serves as our primary short-term support level. Notice how the volume and number of transactions spiked during this descent, indicating heavy institutional distribution. The 1.3350 level, which previously acted as support, has now flipped into a formidable resistance barrier. If the price cannot recover above 1.3350 quickly, the bearish bias will likely intensify in the long term. Switching over to the 1-hour chart, we can analyze the micro-movements during the late February consolidation. Between February 23rd and 25th, the pair was oscillating in a tight range between 1.348 and 1.352. This sideways action often precedes a large breakout, and in this case, the breakout was eventually to the downside. On February 26th, we saw multiple hourly candles failing to hold the 1.355 level, resulting in a gradual slide. The hourly VWAP remained consistently above the price action during this period, signaling that sellers were in control. We can see a clear rejection at 1.357 on the morning of February 26th, followed by a steady bleed toward 1.345. This suggests that even before the March GDP data, the market was already positioning for a weaker pound. Short-term traders should note that the 1.345 level acted as a temporary floor before the final breakdown occurred. When prices are stuck in these narrow channels, it is often best to wait for a confirmed break of the high or low before entering. The inability to sustain any momentum above 1.35 has clearly emboldened the bears for the current month's action. Now, looking at the 15-minute chart from the last few days, we see the immediate impact of the recent volatility. Following the crash on March 13th, the pair began a very sluggish recovery during the weekend and early Monday sessions. The 1.322 level appears to have found some buyers, as the 15-minute candles show a series of small, steady climbs. On March 11th, we were still trading around 1.344, but the momentum was already visibly fading. By March 12th, the price had drifted down to 1.337, setting the stage for the massive gap down in sentiment. Currently, on March 15th and 16th, we are seeing the price hover around the 1.3245 mark. This small bounce lacks significant volume, which suggests it might just be a dead cat bounce before another leg down. The intraday resistance is sitting at 1.3250, and we need to see a strong 15-minute close above this to confirm a relief rally. Observe the transactions. They are relatively low today compared to the panic selling we saw last Friday. This consolidation suggests that the market is waiting for the next catalyst, likely Governor Bailey's upcoming speech. If you are scalping this pair, watch the 1.3235 level as a pivot point for very short-term direction. Returning to the daily view, let's summarize our key price levels for the days ahead. Our primary support is 1.3213, and a break below this could open the doors to the 1.3100 psychological level. Immediate resistance sits at 1.3350, which must be reclaimed to stop the current bleeding. Major resistance remains at 1.3500, a level that has repeatedly rejected price attempts throughout February and March. There is a bearish case to be made as long as the UK economy shows signs of stagnation and the US Federal Reserve remains hawkish. The bullish case depends entirely on a positive surprise in future economic data or a cooling of Middle East tensions. Statistically, I'd say there's a 65% chance of further testing the 1.3200 floor this week before any meaningful recovery. A 35% likelihood exists for a sharp reversal if Governor Bailey provides more support for the currency in his speech. Traders should also keep an eye on the US CPI report coming up, as that will dictate the next move for the US dollar. Look for a bullish engulfing candle on the daily chart as a signal that the bottom might finally be in. Until then, the trend is clearly your friend, and that trend is currently pointing lower. Make sure to manage your risk carefully, as the volatility in cable can be unforgiving during these economic shocks. Thank you for watching Explain the Charts, and we hope this analysis helps your trading strategy. This video is for educational purposes only and is not financial advice. Always conduct your own thorough research before making any investment decisions in the Forex market.